Portillo's reported earnings this week. This is one of my favorite restaurant stocks right now, and it isn't just about the loyalty that people have to Portillo's and the phenomenal unit economics, generating nearly $2 million in adjusted EBITDA per restaurant. That compares to a restaurant like Chipotle that generates about $3 million just in revenue. So phenomenally profitable restaurants, but also the company is really kicking into gear with its growth, and that is unit growth. It's growing mainly in the Sun Belt, and that really took a step forward in 2024. Management updated, there's going to be 10 new restaurants added in 2024, and that will continue to fuel the company's growth. The downside was same-store sales were down just a little bit in the quarter. So I want to go through the numbers, maybe put it in a little bit of context, and then put the value of the company into context as well. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to the results. Here's the income statement for Portillo's. You can see that the quarterly revenue, $182 million. That was up from $169 million a year ago. Most of that was because of new restaurants. I'll get to those numbers in just a second. The margin was actually down a little bit. Restaurant operating expenses, 75.5% of revenue. That is up, meaning it was more expensive to run restaurants than the 74.7% margin a year ago. Few things involved there. One was lower same-store sales comps. The other thing was higher costs. That's both on a food side and also on a labor side. So this is one of the balances that restaurants are going through right now. It seems like people are generally getting out of the phase coming out of the pandemic where everybody just wanted to go out to eat all the time. Same-store sales numbers were going crazy for absolutely everybody. Now they're maybe being a little bit more discerning. So we've seen same-store sales comps come down for a lot of companies. They're kind of flattish for Portillo's, but I'll get to that in just a second as well. You can see that net income was down a little bit from a year ago, and that's because of those higher costs. One thing that I did want to show is the company's valuation, because this gets a little bit confusing sometimes. The common stock, 62 million shares outstanding, is what we are buying as public investors. There is also Class B stock that this company has been slowly buying back from the previous private equity owners. You add those two together, you get about a $720 million market cap for the company. And then there is some long-term debt, a little bit of short-term debt as well, $284 million. Add all of that up, you have a company that has an enterprise value of about $1 billion today. I want you to just keep that in mind because the value of Portillo's is what I think is getting attractive right now. So this is the first thing that they always show, and this is what was a little bit concerning for investors now. The stock is down in 2024, and that's why the reaction was actually pretty positive because a lot of the negativity was already priced in. You can see that a year ago, things were going like crazy. That has kind of bottomed out, and they are starting to maybe swing back upward to a little bit better same-store sales comps. They talked a lot about that being more efficient in the drive-through. They're increasing prices just a little bit, 1% price increase in the most recent quarter. So expect this to move back positive. Guidance was still for flat to slightly positive. The reason that revenue is growing is this right here. These are the restaurants that opened in the second quarter in Texas and Arizona. There are 2 more that have opened since then in the month since in Michigan and Mansfield, Texas. The ones that are currently under construction are 2 in Texas, 1 in Florida. Those are the old restaurant design, and this is what they call the restaurant of the future. This is a smaller format, 6,300 square feet. So basically, it's meant to have mostly a smaller dining area, a little bit more efficient kitchen as well. The idea would be you're still going to have the drive-through, so you're going to still have that business, you still have pickup, but you're going to spend a little less money building these restaurants, saving, I think it's about $1 million per restaurant on the build-out, and you're going to be able to generate very similar revenue. So we'll see how these go. The one thing to notice here, 7 of these 10 restaurants are in Texas. There's a reason for that. They are now moving into more markets in Texas, so Houston is going to be added this year. But they need to build scale in local regions. When you're sourcing food and specific food for a restaurant like Portillo's, if you just have one restaurant in Dallas, it's going to be very inefficient to be sourcing food for that area. It's also going to be very inefficient to be doing advertising. So as you build out more scale, you're going to get more efficient in your operations and also in your marketing. So they're building out that scale first in the Dallas-Fort Worth area, now moving into Houston, but look for this to be something that those margins are going to go up slowly over time as they get to scale in each regional market. So a dynamic to look at long-term when you get beyond just the 85 or so restaurants they have today. Financial profile, you can see these numbers are moving up and to the right. That's exactly what we want to see. Same store sales, again, a little bit weak. I'm not super concerned about that because a lot of this is just about consumer preference right now. We're not seeing people not want to go to Portillo's. They're just maybe trading down a little bit, maybe going a little bit less often. That's why you have a little bit lower restaurant level EBITDA margins, but still really strong margins overall. And again, last 12 months, $169 million in restaurant level EBITDA. That's about 85 restaurants. That's about $2 million per restaurant. Their outlook, the one change was this was, I believe, just slightly positive. Now it's flat to slightly positive. So they are expecting those same store sales comps to kind of go up a little bit in the back half of the year. They did add another restaurant. So this used to be 9+. Now it's 10+ units are expected to open this year. And still long-term expecting 12 to 15% unit growth, low single-digit same store sales growth. And that gives you overall mid-teens revenue growth and adjusted EBITDA growth in the low teens. So again, if a company can grow its revenue mid-teens and adjusted EBITDA low teens, and you're paying $1 billion for the company, that can be pretty attractive when you are talking about adjusted EBITDA with the margins that we have right now. This is one of the disclosures that they added this quarter, and I think this puts into context the growth that's coming from new restaurants. So this same store sales number is actually restaurants that are more than 2 years old. They have kind of a honeymoon period early when a restaurant opens, and then revenue dips a little bit. As people have already visited, you kind of become a little bit more regular, and then things begin to grow on a more normal path after about 2 years. So this is something they kind of covered a lot on recent conference calls. But this is where there was a dip in same-store sales was a lot of the existing restaurants at 70 restaurants. The restaurants that were opened this year generated just $3.4 million in revenue. The restaurants opened in last year for the 2 quarters ended in the second quarter, generated almost $40 million in revenue. And then there was just one opened in 2012. So these are the additions that are coming into the system. Again, this number, fiscal 2024, this is going to be much, much larger as more of those restaurants. There's going to be 10 restaurants. We'll see. They have not disclosed how many they're going to open in 2025, but should be in excess of 10 given the plans that they have and the more efficient that they're getting in expanding their restaurant base. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I don't think there was anything really surprising about Portillo's results. We knew that the consumer is kind of pulling back a little bit. It seems like a place like Portillo's is going to be one of the companies that's going to be affected. So those same store sales numbers didn't end up being all that surprising for me. What I do think is nice to see with Portillo's is they're adding restaurants. They continue to do that at a really rapid rate. And that's really the way that they're going to add value long term. When you can generate $2 million from a restaurant, it's worth building those as fast as you possibly can when they cost $4, $5, $6 million, depending on the design that they're using. I think $5 million is the most recent estimate. So the payback on those is pretty quick from a restaurant perspective, and that should generate revenue and EBITDA over the course of decades. This is a company that has been around a long time in the Chicagoland area, so extending that portfolio into other parts of the country. And the price is right for the stock as far as I'm concerned. $1 billion enterprise value. If you look at restaurant level EBITDA, depending on whether you look at the second quarter numbers or the first half numbers, you get between $160 and $180 million restaurant level EBITDA run rate. So the multiple that investors are paying right now for that is about 6 times. I think that's a pretty attractive multiple for a company that's expecting to grow in the double digits. So this is a stock that I own, definitely looking to add on this general weakness in the market, general weakness in results, because I think these are things that will turn around. And as they get more scale in both operations and also their marketing, we will see revenue grow and also profitability and adjusted EBITDA grow. But let me know what you thought about Portillo's results. Leave those in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.